Good afternoon, students. Hopefully, all of you are keeping well. Now, the key point in this discussion or the lecture which we are going to have is the difference between various set of terms which I am going to take into account. Number one, factor cost and market price. Second one, gross and net. And third is domestic and national. I hope it's quite visible, students. If it is not, kindly concentrate more on the audio part in case you don't get the visibility. Now, let's start quickly. The first one being factor cost and market price. Now, the difference between the two is referred as net indirect taxes. So, first I write down the formula and then I'll explain it. Factor cost is equals to market price minus net indirect taxes. Am I clear? Is equals to market price minus net indirect taxes. Now, what you have to remember is when the goods come out of the factory, they only include the cost which a producer has to pay to the factors of production. But when it is finally made available to the consumer, the price increases because of the indirect taxes paid by one person, borne by the other person. The price is increased because of indirect taxes, and government gives from time to time certain amount of subsidies to such firms which help in reducing the price of the product. So when the goods come out of the factory, its price increases because of indirect taxes, but at the same time the price decreases because of subsidies. The difference between the two terms is referred as net indirect taxes. So indirect taxes minus subsidies is net indirect tax. Am I clear? Remember, market price and factor cost, the basic difference is net indirect taxes. The formula can be changed also. What is the formula? Factor cost is equals to market price minus net indirect taxes. Or we can say market price is equals to factor cost plus net indirect taxes. For the time being, you will remember this much, right? Indirect taxes, amount charged by the government from the producers and the firms, which increases the market price, and subsidies, the benefits given by the government to the producers, which decreases the market price. Am I clear with? Let's move ahead. The second one, gross and net. Now, gross and net relates to fixed investments, primarily investments made in machines, investment made in plants. Now we know it. Whatever we have produced during the year, there might be some portion which has gone to the repair of the previous fixed asset. So what is the new investment? That is called as net investment. Gross is the total of new plus repair of the old. What is the difference between the two? It is called as depreciation, often called as consumption of fixed capital. Right? So how we'll arrive at depreciation through these two? We can take out depreciation by either subtracting net from gross, or we can take out net simply by subtracting depreciation from gross. Am I clear with? Come to the last one, domestic and national. Now the difference between these two is referred as net factor income from abroad. Right? Net factor income from abroad. What our residents earn from rest of the world is factor income from abroad, and what their residents earn from India is factor income to abroad. Now, how to arrive at national from domestic? National is equals to domestic plus NFI FA. Am I clear? Alternatively, domestic is equals to national minus NFI FA. I hope it's quite clear. The difference between factor cost and market price is net indirect taxes. The difference between gross and net is depreciation, and the difference between domestic and national is net factor income from abroad. Remember these three set of formulae. You will be requiring it as we move ahead in calculation of national income. Thank you.